Capital gains tax was designed to be fairer than income tax. Instead, it became the mechanism that made inequality inevitable. The story we're told is straightforward. When you earn a salary, you pay income tax. When you sell an asset for profit, you pay capital gains tax, usually at a lower rate. This difference exists, we're told, because capital gains are riskier, less frequent, and we want to encourage investment. Makes sense. Sounds balanced. But this framework obscures a deeper system that was built deliberately, and the people who built it understood exactly what they were doing. In 1921, the U.S. introduced preferential capital gains rates for the first time. Wealthy industrialists, Rockefeller, Carnegie heirs, railroad magnates, faced income tax rates climbing towards 70%. Their advisors quietly observed that profits from selling stocks or property faced no such burden. Congress, populated by property owners, carved out the preference. It wasn't accidental, it was structural. For decades, this worked quietly. A CEO earning a $500,000 salary paid income tax. That same CEO's $5 million stock sale paid capital gains tax at roughly half the rate. The gap widened. By the 1980s, under Reagan, long-term capital gains rates dropped to 20%, while income tax topped 50%. The message was clear. Wealth generated through ownership would be taxed less than wealth generated through labor. Here's where the system closes the loop. Wealthy individuals don't primarily earn income. They own assets, stocks, real estate, art, businesses. Those assets appreciate. They sell them at a gain. They pay capital gains tax, lower than income tax. Then they repeat. The ultra-wealthy's annual tax burden often falls below what a surgeon or lawyer pays. The IRS data confirms this. Households earning over $10 million pay an effective federal rate around 23%. Median income households pay 13% in federal tax, but factor in payroll taxes and the gap inverts. The current structure, where long-term capital gains are taxed at 0, 15, or 20% depending on income, was locked in around 2003. It remains unchanged. Meanwhile, wage earners face rates up to 37%. This isn't a tax policy. It's a wealth preservation mechanism, and it was predictable because it follows a pattern. Whenever the gap between rich and poor narrows, the wealthy redesign the tax code to widen it again. The implications ripple outward. Public revenue declines while wealth concentrates. Governments cut services, raising borrowing costs. Workers face wage stagnation and higher debt burdens. The system doesn't collapse, it calcifies. Those with assets buy more assets. Those without assets buy debt. The feedback loop tightens, and the capital gains tax structure sits at its center, invisible but essential to how it all holds together. Understanding this structure doesn't require outrage. It requires seeing how systems work, who benefits, who designed it, and what feedback loops maintain it. Capital gains taxation isn't broken. It's working exactly as intended for the people who wrote the rules. That's not a flaw. That's the design. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the systems others overlook, new structural breakdowns every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.